There's been a lot of talk recently about the rising prospect of a recession in Europe, but also in the United States and elsewhere in 2022. Now, the reasons behind that recession probability are actually quite interesting, and we'll go into that in this video, but also we'll look at which variables you should be monitoring to keep your finger on the pulse of growth, because that'll help you monitor the situation and kind of cut through the noise that you hear in the news flow. So let's look at the prospect of a recession in 2022 in a bit more detail. Disposable income is how much of your income is left over once you've paid all of your bills, and that's a big driver of GDP. In this data from the Resolution Foundation, they've produced a forecast of what will happen to disposable income for the UK between 2022 and 2023. Now, here on the left of the graph, you can see the lowest income households, and here on the right, you can see the highest income households. But what's interesting is that pretty much across the board, they expect disposable income will fall by around 3.5% to about 5.5%, with households at the bottom and the top of the income spectrum having the greatest impact. Now, in turn, that's going to be a drag on UK growth because people will have less money to spend on goods and services, and it'll also affect the income for companies, and it'll be a drag on the equity market. Goldman Sachs has done a similar breakdown for the US, again breaking it up by household income into 5 categories. And what they show in the left-hand panel is what percentage of income is spent on gasoline and food. Notice for the poorest households, that makes up almost 1/5 of their total expenditure, whereas for the most wealthy households, it's only about 5% of their total expenditure. Those are the components, remember, which have actually increased a lot, particularly gasoline, which is up 40% year on year. If we look at the impact of that on real disposable income, you can see that overall it produces a drag of about 0.7 percentage points. So just as in the UK, less money to spend on goods and services will be a drag on growth and on corporate earnings. So this is one of the reasons why investment banks have been downgrading their growth forecasts for the US and for Europe. So for example, Goldman has reduced its forecast for US growth in 2022 from 2% down to 1.75%. So still not a recession, but still lower growth than they expected. One indicator which has many people worried at the moment is called the yield curve. So what you can see here is how much it costs the US government to borrow over a 1-year period and a 10-year period. Notice how most of the time the 10-year yield, the 10-year borrowing rate, is more than the 1-year borrowing rate, sometimes by a huge amount. So in April of 2021, you can see the difference was extremely large. So at that point, the curve was very steep. Whereas if we go back to 2019, you can see that the 1-year rate and the 10-year rate were very similar. And at that time, the curve was actually high and flat. Now, what really spooks markets is when the curve inverts, when the short-term rate is higher than the long-term rate. Because usually what happens 12 months later is that we have a US recession. So the New York Fed has a model where they take that curve steepness, they put it into an equation, and that comes up with a forecast probability of recession over the next 12 months. Here's the output of that function based on the shape of the yield curve, and it's a probability between 0 and 1. The actual recessions are shown here in the shaded regions, and you can see it does have some false positives, as it did in 1967, again in 1997, and again in 2000, but generally it does pick out those recessions. In fact, recently it picked out the very brief recession we had after the pandemic in 2020. Now, this model is published every month. It was last published at the beginning of March, but maybe you don't want to wait until the end of the month until you see what the model's forecasting, because the shape of the yield curve can change very quickly. So if you want to do this for yourself, I've created this very simple spreadsheet where you enter the 10-year Treasury yield, the 3-month Treasury yield, you subtract one from the other. So currently the steepness is 1.7%, and then you put it into a function which is built into Excel or, as you can see here, in Google Sheets. That's a normal distribution function. You've got 2 constants here. Don't worry if you don't know what that means. If you're mathsy, you will. If you're not mathsy, you won't bother with this. But this way you can just enter those numbers into the spreadsheet and it comes up with a probability. And you can actually get these yields from websites like MarketWatch. So let's say the Fed raises interest rates to 2% by the end of this year, but the 10-year Treasury yield doesn't really increase. And that would be because growth expectations wouldn't rise particularly high, say. So let's say we entered 2% here for the 3-month Treasury yield. So the curve is now flat. Well, suddenly the probability of recession increases almost to 30%. And if the curve inverts, let's say we increase this to 3%, then the probability becomes 50-50. You can do something similar with the UK market using the gilt yield curve. So gilts are UK government bonds. And this is again data from the Resolution Foundation. The dark shaded regions are technical recessions. So those are official recessions, if you like. The regions which are light grey shaded are actually sharp slowdowns. So not quite recessions, but certainly periods of weak growth. And again, you can see there is a fairly good relationship between the steepness of the yield curve and curve inversions and periods of weak growth or actual recessions. So recently you can see that the yield curve has been inverting, and that is a worry for UK growth, just as it is for the US. And in fact, notice that the probabilities for a UK recession are much higher than they are for the US at the moment. And if we go back to that Goldman research report, what they're actually saying is that they expect a roughly 1/5 to 1/3 probability of a recession in 2022 now, which they say is actually consistent with what they're seeing for the yield curve. And here I'm assuming what they're putting into the yield curve is where we'll be at the end of 2022, assuming we get about 7 rate hikes from the Federal Reserve. Now, the economy is not the stock market. What we care about as investors is more about what happens to earnings for corporates. And if we look at the quarterly increases, which are the year-on-year growth of earnings for US equity, and this is for the S&P 500, what we've seen recently has been very strong growth. The Q4 earnings season was very strong at over 30% year-on-year growth, but what we're seeing for Q1 of 2022 is much lower earnings growth. So the worry now is that we're going to see lower margins because we've got very high input costs. High commodity prices will wear on margins for companies in the US, just as they're affecting households in a negative way. One controversial example is Elon Musk, who's actually been tweeting about inflation for once. He doesn't usually care about inflation, but what he's saying is that both SpaceX and Tesla have both had negative impacts on their profitability, and that's because of inflationary pressure for their input costs. So that's their raw materials, such as nickel for their batteries, aluminium for the bodies of their cars, but also the cost of logistics. If you have to move stuff around, you have to use fossil fuels, usually in the US, to do that. But of course, it's not just Tesla which is affected, it's any company which depends on those raw materials. Now, this week, JP Morgan came out and said that Europe is not currently pricing in a recession. That's despite the fact that we've seen the sell-off in equities being much sharper in Europe than it has been in the US, at least for the broad market. Notice how the forward price to earnings ratio for Europe, in contrast with the US, is not particularly high. And it's also been falling very sharply recently. But we're still well above where we'd be if we were expecting a sharp recession in Europe. So certainly some of the bad news has been priced in, but by no means all of it. Now, the current forecast for GDP growth in Europe from JP Morgan is over 3%. But they say that if it fell below 1%, then we'd have to start re-rating equities downwards. So then we'd be thinking more about these kind of levels where you can see the red dashed line. If you want to keep abreast of what's going on in the macroeconomic space, but also how it affects your investments, you can do that by signing up for our free weekly market roundup. I try to keep it punchy, it comes out on a Friday evening, and I always try to put a funny tweet in there, which is the most popular content. If you want to learn more about that and how to sign up for it, just click on the link beside me or look in the description beneath me. Another indicator which has people worried is credit conditions. If companies want to borrow, they can do that from banks or they can do it in the corporate bond market. Now, generally, when credit conditions are easy, then it's very cheap and quick for a company to get capital through the door and expand its business and its earnings. So generally, when we see that there are tightening credit standards, as there is usually during a recession, then that's bad for the equity market. We saw that in 2008 and 2009, say. Then as credit conditions eased, we saw markets rally. Well, if we look at recent credit conditions, and this is from the US Senior Loan Officers Survey, you can see that they've actually been very easy recently. And this was last updated in January of 2022. So on the face of it, that's certainly a positive for the equity market right now. However, a more timely indicator of what's going on in the credit market is to look at credit spreads, and these are taken from the corporate bond market. So here, for example, is the spread on BBB bonds in the United States. So these are of a credit quality which is just one notch above junk, so pretty poor credit quality. And notice how the credit spread has actually been widening quite sharply since the beginning of the year. Now, this is the extra yield which investors insist upon in order to buy corporate bonds and in order to take credit risk. So the fact that it's increasing suggests that people are moving away from corporate bonds because they're more worried about the credit risk. It's nowhere near as high as it was during the peak of the pandemic sell-off. There, the BBB spread reached almost 5%, but you can see that it's increasing sharply. And if we look at this tweet from Efficient Market Hype, you can see the spreads on markets not just in the United States, but credit markets globally. Now, the one that really stands out is what's happening to the high yield market in Asia. There you can see the spreads have widened hugely, and that's largely due to what's going on with property developers in China. The US market is here in the middle, and as we've already seen, that is widening, but nothing like the high yield market in Asia. And then finally, they show Europe at the bottom, and there we are seeing very sharp steepening, much more so than in the United States, say, but less so than in Asia. So if you buy one of these junk bond ETFs, you can actually see the price falling as those yields widen, and that's driven by a widening spread. So the sell-off that we saw during the pandemic sell-off was around 30% with a very rapid recovery, and year to date, HYG, which is the largest US junk bond ETF, is down by just under 8%. So the story that we're seeing from the corporate bond market is also one of deteriorating fundamentals. So even though the Fed hasn't really got into its Fed hiking cycle yet, you can see that credit conditions are actually tightening already. Now, that usually has a chilling effect on the equity market, but I think it's a direct result of the commodity shock that we've seen and the very high inflation spike, which is actually working its way and rippling through markets across the world. Now, everything we've discussed so far has been pretty much the central case. That's assuming that things are just as they are. But it's often useful to look at the risk case. Now, by risk case, what I mean is something that could actually make things much worse, both in terms of GDP growth, but also market impact. And certainly one such risk case would be if Russia switches off gas and oil to Europe. Now, that's because Europe depends so heavily on Russia as a source of fossil fuel. Germany in particular depends on Russia for more than 60% of its natural gas, and it's not clear how German manufacturing could actually operate without that supply of gas. So if this were to happen, I suspect that Europe would be plunged into a very deep recession and the equity market sell-off would be very severe. Not only would it affect Europe, but it would spill volatility across the world. Now, I'm not trying to scare people here. I'm just saying that this is a news story that you should definitely be watching out for, because if it does happen, things could get a lot worse, particularly in Europe. So I think that covers the key reasons why people are more worried about a recession in 2022. Remember, the longer this goes on, the greater the effect on the commodity market, which in turn is more likely to erode corporate margins. Think of the example of Tesla. But also use those real-time indicators like spread in the credit markets, but also the steepness of the yield curve to keep your finger on the pulse of what's going on. And of course, another way to do that is by signing up for our free weekly market roundup. You can learn more about that by clicking on the link beside me and in the description below me. And as always, thank you for listening.